Trading is not just about numbers and charts, it's equally about the psychology behind every decision. Even seasoned traders can fall into psychological traps that can quickly endanger their careers. Here are some common psychological mistakes traders make and how to avoid them. 1. Taking on more risk than you can handle. When traders take on more risk than they can manage, stress can take over, leading to poor decisions. This can jeopardize not just a single trade, but their entire trading career. 2. Becoming married to a trade. Ignoring stop losses and letting losses mount just to be right is a dangerous habit. This stubbornness can lead to significant financial damage. 3. Letting ego take over. Some traders become more focused on proving how smart or clever they are rather than making money. This ego-driven trading often results in unnecessary risks and losses. 4. Mismatched systems and personality. A trader's system must match their personality and lifestyle. For instance, someone who enjoys fast-paced action should not be a long-term growth investor. Misalignment can lead to frustration and inconsistent results. 5. Panicking. After consecutive losses. Traders who lose multiple times in a row may panic and switch systems. However, constantly changing strategies can prevent traders from experiencing the long-term benefits of a proven system. Solutions for psychological pitfalls. 1. Understand and accept risk. Before entering any trade, understand the possible risk of loss and accept it from the start. If trading becomes too stressful, it's a sign that you're trading too big. Scale down to a more manageable size. 2. Honor your stop losses. Always honor your stop loss or trailing stop the first time. Holding on to a losing trade isn't worth the stress or damage to your psyche. 3. Separate ego from trading. Remember, it's your system that wins or loses, not you personally. Maintain discipline and don't let your ego drive your trading decisions. Focus on the strategy, not on proving yourself right. 4. Align your system with your personality. Ensure that what you are trading, the time frame, and the trade size align with your personality and lifestyle. Comfort with your trading plan is crucial for long-term success. 5. Stick with a proven system. Identify who you are as a trader and find a system that fits you. Once you have a proven system, stick with it and trust in its long-term benefits. Consistency is key to improving trading success. Conclusion. By recognizing and addressing these psychological pitfalls, you can enhance your trading discipline and performance. Understanding the mental aspects of trading is just as important as mastering the technical and analytical parts. Stay focused, stay disciplined, and continue to refine your approach. Trade smart and stay psychologically strong.